Okay, we are back. In this section, we are going to talk about another trade example. We've gone over placing a trade in several different vehicles. We've looked at stocks, indexes, ETFs, and now we're going to look at the SPX. The SPX is the S&P 500 index. It's a very large, high-priced underlying. And there's just something a little bit different about trading a stock index that I want to make sure that you understand, so that if you run into this when you're placing trades, you'll know what to do. And so let's go ahead and jump right in. There's a couple things I want to talk about. One is dealing with put skew. And what put skew is the fact that in a lot of stocks, individual stocks, and individuals and stock indices, or a stock index, a lot of times there is what's called put skew. And all that means is that the puts are priced higher than the calls. And the reason that is because the risk is usually to the downside when trading options on a stock or index. The velocity in which the market moves down a lot of times is much quicker and with more velocity than an up move. The analogy that you'll hear is the stock market takes the stairs up but the elevator down. And so to account for that, the puts are priced higher to account for that downside potential velocity. So let's take a look at an example and I'll show you what I mean. So if we pull up the platform, and I've already got this set up, so I've gone through the steps of how to set up the trades. And so what I've done, I've gone through and I set my short strikes at the 20% probability of being in the money. And so here's the graphical, the visual graph of our trade in the SPX, S&P 500 index. And so let's go ahead and we'll set our slices like we always do to break even. 617 is expiration, so we've got a little over 60% probability of profit. The one thing that you'll notice about that's a little bit different from some of the other trades that we've set up is look at where this is where price is trading right now, and look where this is in relation to the rest of the graph. It's farther over to the right hand side than it is to the left hand side. And because the puts are more expensive, when we look at the 20% probability of in the money puts, they're much further away from where price is currently trading than are the calls. So the calls are closer because they're cheaper. And again, that's to account for the downside velocity. So you have a lot more protection going to the downside. So a couple things. One, I place the trades and I take into account this put skew, meaning I place it based on 20% probability of in the money, because that's how the probabilities actually do play out over time. And I like to have a little bit of what I call short delta, or downside protection, in my trades, so that if we do see a major downturn in the market a certain day, if you put this trade on, it's not gonna hurt you as bad. And in fact, if it starts to go down, you'll actually start to make money right away, as you see the pink line right there, the profit line. So I just want to make sure when you set this graph up and you see it kind of skewed to one direction, that's why the puts are more expensive. If we go to the trade tab, and I'll show you what I mean, let's look at the 20% probability numbers, because those are the options that we're selling. So if you look at this one, and we always default to the higher of the, when you look for 20%, you default to the higher percentage. So in this case, it's a little over 21%. And what you'll see is that these calls are trading at 8.10 bid, 9.10 ask. So right between 8 and 9, let's say, just for rounding. So remember that they're trading between 8 and 9. Well, if we look at the 20% probability on the put side, these are trading for between 12 and 12.80. So about 12.5 is probably where you would get filled. So 12.5 versus 8, that's quite a bit of difference. And so that's what's reflected on the graph here. So there's a couple ways to do this. You can place the trade just like this, and that's what I do. And there's no problem with doing that. You're just giving yourself a little bit of downside room to do so. The other thing that traders will do in this situation, because if it does start to really move up, you're seeing that your profit line really slopes down pretty quickly over here. So to account for that, what they will do is they will simply buy a single call to cut down that directional, what we call delta. So let's just take one of these price slices and move it over here to where price currently is. And then what you can see down here is, if you look at your price slices, this one's the 2058. So you can see the delta of where price is right now on this trade is a -7. Okay, that means we have it that if for every point the market moves down, we'll make $7 on this trade. Okay, so some people don't like to have that negative delta. They want to set up a trade and they want it to be what's called delta neutral. Well, one way to do that is we still can account for the skew and put on the graph so it's at the 20% probability of being in the money on each side. But what you can do is you can buy a single call. And, what we'll do to look at that is what we really want to do is cut that delta in half. So right now it's a little over -7. So we want to get that down to about -3, or even a little bit less is fine. So what we can do, delta is a term that's also synonymous with probability of in the money. So if we're looking at a -7 delta, we want to look at if we want to cut it in half, we can look at a delta of about 3.7, that would be about half. And by buying this call, that is going to help neutralize our delta, or help make our trade more delta neutral as opposed to skewed to the downside. So if you just right click on that call and do buy single, it's going to populate here, and then just take that, right click and do analyze trade. Get rid of this one here. And if you see what happened to our graph is now this pink line, our profit line, doesn't continue to slope down this way like it was. It actually flattens out and starts to curve up outside of our graph. So what this does is it flattens out that delta. It takes away some of that directional bias that is included with the trade by just setting it up in our normal fashion, and gives you a little bit more protection if SPX were to continue to the upside. So again, I'm giving you two different ways to do this, because some people prefer to have a little bit of downside bias, and some would prefer to actually put it on extremely delta neutral. And so let's take a look at what this actually does to our trade. You can see that when we have this call protection, it's called a protection call. When we have the protection call on there, our max profit is 800, and our max loss would be 2,200. If we were to take that call off, now our max profit goes to 925, and our risk is 2,075. Okay, so it takes away some of our profit potential, but it gives us protection if it continues to move up. So again, watch the graph as I click the call. You can see our max profit goes from 925 to 800. But again, the slope of the pink line, the profit line, is not as skewed to the downside, so it gives us that protection. Hope this is helpful. There's no right or wrong way to do it. I typically tend to, unless I have a real bias that I think the market's going to keep going up, I'll typically put the trade on just like we've walked through every other trade, and I won't worry about that skew, and I'll deal with the trade if it gets to our break even. But some people like to have that extra protection, and so it's just a matter of preference in how you want to do that. So I just wanted to give you that another kind of a idiosyncrasy and kind of a nuance of different things that you can do to help build your trade and help guide you in the best direction that you want to go, depending on what your assumption is. If you think there's more room to the upside, you probably want to add the call. If you're okay with the skew and you think it may be going to the downside, then you can leave it as is. Nobody knows what the market's going to do. There's no magic about one way or another. It's just a matter of preference. So hope this helps, and we'll see you at the next video.